Welcome back. You're watching Traders Corner, Summit TV's real-time and real money trading show. As always, I'm joined by Garth McKenzie, who is, of course, the founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, let's start off with Aspen, which is, I think, proving to be a bit of a millstone around the neck of your trading portfolio. What do you make of its progress over the last couple of weeks since you bought it?
Yeah, I don't have a chart of it here with me, but just to talk about it, I mean, it's really, we entered this trade around about 3 weeks ago. We long from 165 Rand a share, and it's still 165 Rand a share 3 weeks later. So it's been frustrating. It's been down into the lower 160s. It's been up a little bit, but largely it's just gone sideways. What I will say is that, generally speaking, a stock gets in a nice rising trend and then it consolidates sideways like this. In most cases, that's quite a healthy scenario. So it probably still will break to the upside. So I'm going to continue to hold the trade and give it the benefit of the doubt. But having said that, it is frustrating, and particularly, wanting to get off the mark with the show this year and start to put some money in the bank. It's quite annoying to have a trade like that that's just really churning along sideways. There have been other stocks I could have picked which would have yielded better results for us, but it's always easier in hindsight.
Yeah.
So I think for the moment we're going to sit tight and let it do its thing, but we're also looking elsewhere for other opportunities as well.
Okay. I know that before we get to this week's stock pick, you want to look at the bigger picture and focusing particularly on the S&P 500, which you've done a bit of research into, and you seem to have a few interesting thoughts about this.
Yeah, I have. I mean, I was working on my column for the Investors Monthly magazine and writing a story about the S&P 500 and basically looking at earnings over the last 15 years really, and looking at where we are on a relative basis to the past decade or more. If you look at the chart, what you'll notice is that the S&P 500 is bumping up against major resistance at 1550. And when I say bumping up, I mean we're currently trading at about 1520, that sort of area. But you can see the significance of that flat line there. This chart goes all the way back to 1998. And you can see the market peaked there around about 1550 in the year 2000. And again in 2007, and now once again we're having another go at this level again. So this is a big overhead resistance level, and the question now that we have to ask is, what's going to happen? Are we going to fail at that resistance, or are we going to break through it and go and start a new leg of a massive bull market into all-time high territory? And it's quite interesting. What I did was look at the earnings for each of those periods to see when we were previously up at 1550 on the S&P 500, what were the earnings looking like at each of in each of those cases. And if you look in 2000, the S&P 500 earned $56 per share. Okay. So if you thought of the S&P value as a share price, $56 per share, that put the PE ratio at that stage at 27. Now remember, that was the height of the dot-com bubble.
Yeah, so a lot of those earnings would have been made up by, or the PEs would have been made up by those incredibly overstretched valuations that you saw in those tech shares.
Correct. So the market was exceptionally expensive at that time. And obviously we know what happened after that. The market came down in a very aggressive fashion. Then we had another bull market between 2003 up to towards the end of 2007. And at that stage, at the end of 2007, the S&P 500 earned $65 a share for that year, putting it then on a PE of 24. So also relatively expensive. What you must remember is that the long-term average PE ratio for the S&P 500 is 16.
Wow.
So anything above that level is could be deemed expensive, and anything below could be deemed relative value. So now we're getting close to this 1550 resistance once again, and what's the earnings profile looking like this time? Well, interestingly, the earnings forecast for the full year 2013 is for the market to earn $113 per share, which puts it on a forward PE ratio of 13.5. So suddenly now we're sitting around about 20% below the long-term PE average. Yeah. And if you look back, go from 2000 to now, earnings have doubled in the last 12 years. Yet the index value is at the same level. We're still sitting at around about 1550 on the S&P 500. So what you've got to ask yourself is, are we not here now in a much stronger, healthier position to potentially break out through this resistance and go and take out that 1550 resistance and go on into new all-time high territory? And I think we are. I think there's a strong case to be made for another major leg to this bull market to be had over the next year or two or three looking out. to me, this whole situation looks very, very exciting.
Because companies really over the last 5 years since the financial crisis began have been taking out a lot of cost, they've taken a lot of pain, they've made themselves into much better organizations. Yeah. That is obviously one of the reasons, but are there other reasons besides corporate health that you would see a breakout above 1550?
Well, I think there are other reasons. The one that you've alluded to there is the fact that balance sheets are very healthy. They've been made a lot more lean and mean in terms of US companies. A lot of them are also sitting on huge cash piles as well. So there's a lot of, the balance sheet situation for US companies is looking much healthier than it has done for a long time. The other thing, one of the other things is that the Fed has indicated that they will continue to be very accommodative with their monetary policy whilst the US unemployment rate is above 6.5%. And at the moment it's sort of sitting at around about 8%. So what that means is we can expect continued low interest rates in the US whilst that unemployment rate is relatively high, and until such time as the unemployment comes down to under 6.5%. That's the one thing. And then the other thing, which I think is a potential massive theme, is a rotation from bonds into equities. Because over these last couple of years, since the financial crisis, a lot of money, and when I say a lot of money, I'm talking trillions of dollars, has gone into government bonds. It's perceived to be safe in a time of financial turmoil. And if that was to unwind, bear in mind that bond yields have been driven down to historic low levels. And if you're getting paid very little on a bond investment now, and the risk of capital loss on bonds from here, if bond yields were to start to rise, the risk of capital loss on a bond is very, very high. So if you start to see that
great rotation taking place.
That rotation shift, so where money comes out of the bond market, to me the most logical place for it to go is into the equity market, because that's the only place where you're going to get some sort of yield and some sort of growth potential. And if you see this big money shift from bonds into equities, I think that could be a huge theme that could continue to drive these equity markets higher in the years ahead.
In fact, if you look at what's happening on US Treasury yields, they are rising above 2%, and a couple of people I've spoken to the last couple of days say you're almost guaranteed to lose part of your capital if you buy Treasuries now, or Japanese bonds, for example. And I also saw a very interesting article the other day talking about the Japanese pension fund, which is the world's biggest. It has 64% of its assets in Japanese bonds, and now they're really starting to worry about this because they're not earning anything. And if you get inflation ticking up, then you earn even less.
Yeah.
So, yeah.
100%. And I think that this theme that we're talking about here is still very much in its infancy. And if it starts to gather further traction, then I think you could find a huge flood of money moving towards the equity markets. So, I mean, putting it all together, I'm painting a rather bullish picture here.
A very bullish picture. I want to rush out and buy now.
Absolutely. But I think, also technically what you'll tend to very often find is that in a situation like this where you've got an overhead resistance like that, quite often the third attempt is the one that breaks through. And I think if you tie the fundamental story in that we've spoken about here, and look at the technicals together, I think we've got a very good chance that we'll see this S&P 500 breaking through 1550 this year and going on to new highs. And if we were just to get back to the long-term average PE ratio of 16 for the S&P 500, it would mean that the US market would need to rally 20% this year just to get back to a long-term average PE multiple. And that would put your S&P 500 up at about 1800 towards the end of this year. So I'm bullish, and I think that this is everything we've talked about here, I think, supports that bullish view.
Yeah, well, certainly the numbers seem to bear it out. Guys, so this is the overarching picture, but you have actually entered a trade on our local market this week, PPC.
Yes, I have. I've done a trade on PPC. This was identified on the Traders Corner website last week as a possible trade to do this week. So I'm going to quickly talk about it here. The stock has been rising in a rising trend over the last 6 months or so. You can see there on the charts, nice pattern of steadily rising highs and rising lows, indicated there by that upward trend. You can also look at the 50-day moving average, which is that orange line. It's pointing upwards, and regular viewers will know that I always think of the 50-day moving average as being a very good indicator of the medium-term trend. And I've found I've had more success most of the time by trading in the direction of that 50-day moving average rather than trying to trade against it. So in other words, in this case, the 50-day moving average is pointing up. It supports the case that I could be buying this share, which I am. What's also interesting is that this share is consolidated into what's called a falling wedge pattern over the last couple of weeks. And you can see it identified there. Typically, these patterns are continuation patterns within a trend. And in this case, it's a rising trend, so one would expect this consolidation would ultimately break out in the direction of the prevailing trend, which indeed is what's happened. We've seen the share actually breaking up through about 32 Rand 60, which was the top of that rising wedge pattern, and it's been fairly strong today. There's also been positive divergence on the stochastic, which you can see indicated over there. Basically what that means is the stochastic oscillator is making higher lows whilst your share price has been making lower lows, and that is divergence, and in this case it's positive divergence, which is rather bullish in nature. So those are the reasons why I like the trade, and I've gone in, I've done this yesterday afternoon for our portfolio. I've bought at 32 Rand 80. I'm using a stop loss at 31 Rand 70. Now that stop loss would basically be a move below the lowest point of that falling wedge structure that I've identified over there. And then if we have a look at the risk to reward ratio blocks, I'm looking for a move up to 36 Rand here as my target. So you can see the risk
quite a
to
big
reward.
move, actually.
Well, yeah, it's so from 32.80 to 36, it's around about 10%.
Yeah.
So it's potentially a good move. Look, I hope that this one works out and it's not as pedestrian as what our Aspen trade has been, but you never know.
No, if we had our crystal ball, we'd be in Rio on our yacht, on our respective yachts.
Exactly. Trading is about looking at the probability of success and then acting on it. And sometimes it works and sometimes it doesn't. But you want to get the odds stacked in your favor, which I believe they are in this case. So our risk to reward ratio is identified there with the red block being the risk. In other words, the difference between our entry price and our stop loss. And the green block is the difference between our entry price and our possible target price. So
Garth, if you take us through the mechanics.
Yeah, so if we look at the mechanics, I've bought at 32 Rand 80, as I mentioned. Stop loss is at 31 Rand 70. So what that means is that my risk per share is 1 Rand 10 in this case. I've decided that I'm going to risk 1.5% of our portfolio's capital on this trade. We've got about 248,000 Rand in capital at the moment, so 1.5% of that is 3,720 Rand. So if I take it through the calculation that we always do, I divide the portfolio risk and divide it by the risk per share. It gives us a figure of 3,381 shares. So I've rounded it off. I've bought us 3,380 CFDs in PPC. Our target's 36 Rand, as I mentioned, and what that means then is that our risk to reward ratio is 1 to 2.9. So it's a decent enough, our reward is almost 3 times bigger than what our risk is in this case. So if it works, we'll make 3 times more than what we're risking.
You said you hope it's not going to be prove as pedestrian as the Aspen trade has done to date. Does PPC, though, have a habit of spiking up nicely just as soon as you buy it, or could this be a trade where you have to have a little bit of patience?
It might require us to have a bit of patience. Viewers who watch the show a lot will remember that we actually did trade PPC last year, and it also turned out to be a bit of a lethargic. Yeah, it was very lethargic, and we ended up cutting it.
As slow as cement being poured.
Yeah, like watching cement dry. Well, hopefully not this time. Hopefully this share price will move up for us. All the technicals that I've identified there do seem to suggest to me that there's upside potential here. So let's see how it plays out. Like I said, this is a game of probabilities. We identify a trade where we believe the probability of success is in our favor, and then we overlay it with the risk management strategy that we've done. And then if it works, awesome. If it doesn't, we lose 1.5% of our capital and we move on.
Garth, before we get to what the portfolio looks like in upcoming courses, just a note going back to our discussion on the S&P, which I should have brought in, was Bank of America Merrill Lynch came out with, I think they call it their bull and bear index, and they talked about a major contrarian sell signal that investors are more bullish than in 99% of all periods since 2002. Even despite the overarching picture of positivity that you painted, do you think there could be a little bit of a correction?
Look, we are quite overbought on all markets because we've been running hard for the last 7 months or so. So a correction certainly is possible. I'd like us to have a correction. I think it would be awesome because there's a lot of us waiting for this correction so that we can get on board, and it's just not coming. In terms of those bull and bear indicators, I mean, they're interesting to view. I'm not sure you can always necessarily trade to them.
Okay. All right, so to finish off with, what does the portfolio look like?
All right, it looks like this. So we've got our Aspen trade still open at close yesterday. There was a mark-to-market profit of 500 Rand there. We've got our option structure, our put spread, which is working away in the background, and we'll have that until June. And then I've opened a trade on PPC today, yesterday, 32 Rand 80. We are on the right side of that trade, so things are looking good. So overall, our portfolio is sitting at 248,500 Rand. It's slightly in the red for the year, but generally speaking, still looking okay.
And Garth, very quickly to end off with upcoming courses?
Yeah, I've got 2 coming up, one in Johannesburg on the 2nd of March and one in Cape Town on the 9th of March. So anybody that's interested in attending one of those high probability trading courses can email me, garth@traderscorner.co.za, and I'll send you the details.
Okay, great. We'll have to leave it there. Garth, thanks as always for joining us. That's Garth McKenzie, founder and editor of Traders Corner.